Hi, this is John Coumarianos with Mindful Advisory, bringing you a new edition of Driving Returns. Big day in the markets today. U.S. stocks were down big. Both the Dow and the Nasdaq were down more than 400 points. The S&P 500 lost 1.7%. The Nasdaq lost 2.55%. That's a pretty serious decline. I'd like to call your attention to the fact that on August 22nd, we posted a video saying it might be a good time to rebalance. Looks like that was true. We weren't calling for anyone to sell all their stock exposure, just gently rebalance your portfolio if it had deviated from the target allocation, which it most likely had at that point, because up until now, U.S. stocks especially, have had a terrific year. If you can do it in a tax-advantaged account, rebalancing is often a good idea, getting back to your target allocation. Along these lines, our friend Brett Arends at Market Watch had a terrific article today showing how investors have been throwing money at U.S. stocks after they've gone up. He cited some flow numbers and some options activity suggesting that investors were eager to invest more and more in U.S. stocks. Typical bad behavior. You want to moderate your behavior towards stocks when they rise a lot, as they have over the past couple of years. Obviously, 2022 was a bad year for stocks, but boy, they've rebounded in a big way last year and this year so far up until now. And that's when you want to be gently reducing your exposure. Brett Arends' article couldn't have been more timely. Um, the second thing I want to mention is that back in March, we posted a video suggesting that real estate investment trusts, REITs, were not necessarily cheap, but they looked reasonably valued or valued at average prices relative to a typical cash flow metric that REIT investors used for their 25-year history. So not cheap, but not expensive either, whereas the broad U.S. stock market looked expensive. And I speculated that there was a decent chance that REITs could outperform U.S. stocks over the next few years, just based on that simple cash flow metric. I wasn't adamant about it, but it just so happens that from March through yesterday, September 5th, so not even including today, when the broad U.S. market was down and REITs were basically flat, REITs have outperformed the broad U.S. market something like 13% to around 8% using the Vanguard indices, the Vanguard Real Estate Index Fund and the Vanguard S&P 500 Fund ETF. So I never want to make the claim that I'm able to make sector calls, tell you which sector will outperform the broad index. Holding a broad index fund is unquestionably the best thing to do for most investors. But we did take note of the fact that REITs looked like they were carrying an average valuation, and the broad U.S. market decidedly was not carrying an average valuation. So sometimes you can make gentle trades like that can work out. But don't want to make the claim we do that on a consistent basis. Broad index funds are generally the best way, but rebalancing is important. You don't want to throw money at stocks when they've been up for a long period of time. You want to gently reduce your position and get back to your target allocation, whatever that may be. So this is John Coumarianos signing off for Driving Returns and for Mindful Advisory. Thank you for watching. Don't hesitate to contact us if you have questions about asset allocation and retirement planning and general financial planning. Thanks very much. So long.